To my channel, I'm Doris and I'm here to share with you about my stock account and today's market update. Today my stock account has made a loss of $4,437. US stocks were mixed and Meta helped the Nasdaq closed with 33.3% higher. Dalio won't see Fed easing. The market should trust Powell's statement on the interest rate outlook. Let's first take a look at my account. Right now, the net asset of my account is $66,176.89. In total, I've made a loss of $35,004.57. Today, I made a loss of 6.25%. But I believe this is the end of the bullish cycle. SQQ lost 10.4% today to $33.01. But during the post-market, it rose for 3.88%. The RV decreased for 6.83% to $36.53. In the post-market price, it rose for 1.26% to $36.99. Looking at the market today, Dow Jones Industrial Average lost 0.11%, Nasdaq Composite rose for 3.25%, S&P 500 rose for 1.47%. Today, the tech stocks opened extremely high, made a big gain. Internet content and information sectors rose for 8.96%. Software infrastructure rose for 3.78%. And software, application and consumer electronics, internet, retail all rose by more than 3%. However, on the other hand, healthcare industry and oil and gas all made a big loss of more than 2%. The S&P 500 hit its highest level in 5 months. Meta Platforms' surge pushed the Nasdaq up. Markets are still assessing the significance of the Fed's 25 basis point rate hike and the outlook for future monetary policy. Both the European Central Bank and the Bank of England have raised interest rates by 50 basis points. Meta shares jumped 23.3% after it beat fiscal fourth quarter revenue and announced it'll buy back $40 billion of shares. However, it's worth mentioning that Reality Labs, a widely watched Meta unit that includes the Meta Space business, continues to burn money. Its revenue in the fourth quarter of 2022 was $727 million, down 17.1% year-on-year. The quarterly loss was $4.279 billion, and the annual loss was $13.717 billion, up 29.5% and 37.57% respectively. Markets are still discussing the Fed's interest rate decision on Wednesday. The Fed raised interest rates by 25 basis points, less than the 50 basis points raised at its December meeting, making investors optimistic that the U.S. inflation has cooled far enough to allow the central bank to raise rates cautiously. But the Fed did not say it was about to suspend raising interest rates. In his speech on Wednesday, Fed Chairman Colin Powell reiterated his previous position that the fight against inflation is not over yet, and that the central bank needs to keep interest rates high for longer. But investors have largely ignored his comments, suggesting that disconnect between the Fed's information and financial market responses has widened in recent months. Vantage market analyst Jamie Dutta said, "Traders believe the Fed is lagging behind and the threat of inflation is rapidly fading. The Fed is open to changing its mind, and if the economy fails to lose steam, they may have to do so." On the economic data front, the labor market reported that the new claims for unemployment benefits fell to 183,000 last week, less than expected. On average, economists surveyed by Dow Jones expected 197,000. The labor market will release its January non-farm payrolls data on Friday, which is expected to add 187,000 jobs to the U.S. economy. U.S. employers announced layoffs in January to the highest number since 2020, according to Gray and Christmas Challenger. Companies reported 1,100 and 2,943 layoffs in January, more than double the number announced in December and up 440% from January 2022. Thursday's report showed that the tech sector accounted for 41% of the announced layoffs. The job cuts announced by retailers and finance companies have also increased from a year ago. In a statement, Andrew Challenger, Senior Vice President, said, "We are now on the other side of the recruitment frenzy during the pandemic. Companies are preparing for an economic slowdown, cutting jobs and slow hiring." In overseas central bank news, the European Central Bank on Thursday announced a 50 basis point rate hike and promised to raise rates at the rate next month to ensure inflation falls back to target levels. ECB policymakers raised the deposit rate to 2.5%, the highest level since 2008, and in line with the market expectations. Despite sharp fall in energy prices and the Fed has slowed the pace of rate hikes, the ECB warned that the most aggressive monetary tightening in the bank's history was not over yet. In its statement, the ECB said the Governing Council intends to release rates by another 50 basis points at its next monetary meeting in March. The subsequent path to monetary policy will then be evaluated. The Bank of England on Thursday raised interest rates by 50 basis points to 4%, the highest level since October 2018 and in line with market expectations. Since December 2021, the Bank of England has raised interest rates by 390 basis points. Last day, the Federal Reserve FOMC meeting as scheduled by 25 basis points. The federal funds rate to 4.5% to 4.75%. Mr. Powell said the Fed was discussing raising rates about two restrictive levels before suspending them. He also suggested that he would not cut interest rates this year, given the Fed's expected economic outlook. Mr. Powell also revealed that the Fed was not exploring the possibility of suspending rates before starting them again. While, as usual, Mr. Powell stressed that no rate cut was expected this year, the market was not convinced. In terms of the rate swap market, traders expect the Fed to cut rates by 50 points by the end of this year from its June peak. Specifically, traders believe the U.S. policy rate will peak in June, with an overnight rate call rate of 4.9% and falling to 4.4% by December. Dalio also said any coming recession would not be as bad as he had expected due to the current distribution and contraction of credit, which he concluded. Dalio points to the debt supply and demand problems in the U.S., Europe, and Japan, which make bonds unattractive in the long term. Cash, however, is relatively attractive in the current cycle. In October, with a series of aggressive Fed rate hikes, Dalio challenged its long-term argument that the cash is junk. The facts have changed, and I've changed my view of cash as an asset. I no longer think as cash is rubbish. With existing interest rates and the Fed shrinking its balance sheet, interest rates are now close to neutral, neither very good nor very bad trades. In other words, short-term interest rates are roughly appropriate. For the recent sharp rebound in the digital currency, Dalio also expressed his view. Bitcoin is a little thing that attracts too much attention. In fact, the world's largest digital data is worth less than a third of Microsoft's stock value. As Dalio argues, Bitcoin will not be an effective way to preserve money or wealth. Similarly, stablecoins are not feasible. Mr. Dalio says inflation-linked currencies are the best. Last year, Bridgewater had a highlight moment for heavily shortening European stocks, but as European stocks rallied sharply since last September, Bridgewater's pure alpha fund plunged, giving up most of the year's earnings. According to LCH Investments, an FOF unit of the Rothschild family, Bridgewater's 2022 revenue was about $6.2 billion, beating more than $16 billion from the Citadel, the first last year. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.